Good day, students. Will pass my greetings to those who are listening to this video. And once again, I will be doing this question on the cash flow statement. And this is question 5 of the current year's handout. And it tells us that brackets means credit balance. That means where we find brackets, that will be an indication that this is a credit balance. And it says the following is an extract from the annual financial statements of Echo Ltd for the year ended 30 June 2007. And we are given two comparative years, the year 2006 and the year 2007. And when we do cash flow, I always want to bring your attention to few things that are important, more especially regarding the balance being in bracket as a credit balance. Let us just go to the cash in the bank. Our cash in the bank is an amount of 22,900 in the year 2007. And that cash in the bank is an indication that cash in the bank by the end of the current year was an asset. However, the bank overdraft is negative 11,000 rands. That means we had a liability of a bank by the end of the previous year, meaning it was a bank overdraft as it is stated. And I also want to bring your attention to current tax refundable, which can sometimes be written or noted as SARS. Our current tax refundable, if you see there, which is SARS, in the year 2006, we had current tax refundable of an amount of 6,000, and it is without brackets. That means it's an asset. And also our current tax refundable, which is SARS, it is 46,000 rands in the year 2007, and it is also positive. That is another indication that this current tax is an asset by the end of the current year. That means both the end of the last year 2006 and the current year 2007 end of the accounting period, SARS was owing us the two amounts, 46,000 and 6,000 rands consecutively. And now those were the two very important things that I wanted to bring your attention to before we proceed. And now we have the income statement below that, and also our income statement is for the year 2006 and the year 2007, two comparative years. And remember, when it comes to the income statement, we only focus in the current year because income statement is only focusing on the performance of the business for the current accounting period. Although we are given two comparative years, but the previous year is not there for us to do cash flow, we will only be focusing in the year 2007 when it comes to the income statement items. And if we see the second item in the income statement is what is called goodwill write-off. And remember, goodwill write-off can also be called amortization of goodwill or amortization of goodwill. Remember, amortization is the depreciation of intangible asset. That will be amortization of goodwill. So now if this was written as amortization, which is depreciation of intangible asset, that will also be correct. I just want to bring your attention to that so that if you say it in a different question paper, you are able to attempt that. And in the same income statement, we have the last line item that I also want to bring your attention to. The last line item is gross revenue. Gross revenue is sales. That will be sales revenue. That means it is the revenue before the deductions of the expenses. So now that will be our total sales that we have to take into account when we are doing our cash flow from operating activities. And the next statement is the statement of changes in equity. And the statement of changes in equity, we have two comparative years, once again, the year 2006 and the year 2007. And we are given only ordinary dividends that were declared and paid, and preference dividends that were declared and paid. And now we have two dividends in the statement of change in equity. That means the total dividends that would have been paid will be by the end of the year 2007 a total of 20,000 and 15,000 rands, which will give us a total of 20,000 plus 1.5, which will give us 21,500 of the total dividends that would have been declared and paid by the end of the year 2007. So now let us continue with the exercise and we go to the next page. On the next page, we have the additional information. And in the additional information, I just would like to read it through so that we are able to identify what goes where and what does not go where. So now, because we know that we are dealing with the cash flow, so now we'll be able to identify which one goes to which part of the cash flow. The first additional information, number 1, says on the 28th of February 2007, a right issue of 1 share for every 5 shares held were issued at 3 Rand 40 cents. Remember, a right issue is when the shares are issued at the lower price than the market price. So now this will be cash flow from investing activities. Cash flow from investing activities. I just want to write the abbreviation so that we are able to identify that this is cash flow from financing activities, not investing. Cash flow from financing activities. So now this will be recorded in the cash flow from financing activities. And number 2 says that on the 1st of June 2007, 10,000 redeemable preference shares were redeemed at 13,000 rands. So now if we redeem 10,000 redeemable preference shares at 13,000 rands, and let us go to the statement of financial position or the extract of the annual financial statement, the first one. If we see there, we have 10%, the second line item. The second line item says 10% redeemable preference stated capital, and it says shares at 1 Rand each. That means these shares were issued at 1 Rand. So now when they are redeemed again at 1 Rand. But now we see that we redeemed 10,000 under additional information number 2. We redeemed 10,000 preferences that were issued at 1 Rand. But we redeemed them at 13,000, not 10,000, because it was supposed to be 10,000 shares turned by 1 Rand. That means the difference between 10,000 rands of preference capital and the 13,000 is what is called a premium on the redemption of preference shares, in case maybe you do not know that. So now the reason why they are redeemed at 13,000, not 10,000, that means they have already added the premium. Meaning if the premium was not there, maybe if they had told you that 10,000 preference shares were redeemed at a premium of this amount, therefore now you have to take into account the capital plus the premium, and therefore now that will be the total redemption that will affect the cash flow from financing activities when you do the cash flow. So now this again is a cash flow from financing activities. It will affect the cash flow from financing activities. Then number 3 now is saying that the following transactions regarding furniture took place during the year 2007. And we know that a furniture is a property, plant, and equipment item. So now that means number 3, it will be cash flow from investing activities. That means all the entries that are under number 3, because they are with regard to furniture, they will go to under cash flow from investing activities. Let us read the first bullet point. The first bullet point says that furniture to the amount of 5,500 was purchased. So now this will be recorded as acquisition of furniture, and it will be recorded as negative in the cash flow from investing activities, because money went out to buy the furniture that was costing 5,500. The second one is the furniture with a cost of 800 rands and an accumulated depreciation of 700 was written off. Remember, if you write off an asset, you just derecognize it from the book of the business, either because the useful life of the business has expired. Therefore, now the minute we reach to the total estimated useful life, therefore now the asset must be written off out of the books of the business. So now when it comes to the writing off of the asset, it means in this case there is no money that came into the business and there's no money that went out of the business. However, we have to recognize that 800, or we have to recognize that the value of the furniture, remember the cost price of the furniture was 800. That was the initial cost price. And the accumulated depreciation was 700 in total. Therefore, now if you say 800 minus 700, we realize that the value or the carrying amount of this furniture is 100 Rand. That means carrying amount of this furniture was an amount of 100 rand. And the furniture that had the carrying amount of 100 rand was written off. Therefore, now the 100 rand becomes a loss on the write down of the furniture. This will be a loss on the write down of the furniture. And this loss on the write down of the furniture supposed to have been recorded in the income statement. Let us check if maybe does it appear in the income statement. In the income statement, we don't see it written independently because a loss is included in the total of the expenses. So now it is not a line item separately disclosed. However, we know that that loss of 100 rand was recorded in the income statement and it is included in the net profit before tax. So now we have to remove this because it's a non-cash item. Then after we have the third bullet point that says that a furniture with the carrying amount of how much? 3,200 was sold for how much? For 8,000. The 8,000 will be recorded in the cash flow from investing activities, and that will be what is called proceeds from the sale of the furniture. This will be 8,000 proceeds from the sale of the furniture. But I want to bring your attention, although I'll do clarify this later on. I want to bring your attention to the fact that the furniture is said that the furniture with the carrying amount of 3,500 was sold for 8,000. So now if we sell an asset that had a value of 3,200, but we sell that at 8,000, that means we must have gained a profit on the sale of this asset. And the profit will be the carrying amount minus the selling price, and the selling price was above the carrying amount. Therefore, the difference will be a profit on the sale of the furniture. Therefore, now 8,000, which is the selling price, minus 3,200 will give us 4,800. Therefore, now 4,800 will be a profit on the sale of this furniture. And we know that a profit on the sale of the furniture was supposed to be recorded in the income statement and increasing our net profit before taxation. So now the profit on sale of the furniture will have to be reversed because it is once again a non-cash item. Sometimes that might be recorded independently in the income statement, but in the income statement we still don't see that as visible. However, although that profit is not recorded as a visible line item, it must still be removed because it is a non-cash item. Some income statements, they will show such entries independently where you see the profit. However, in the income statement, we don't see the profit visible, but we can see that there was a profit that was made on the sale of this asset, which is a furniture. Then now the next one will be, please take note of these amounts because they will be useful when we do the reconciliation note. The loss of 100 rand and the profit of 4.8, they are very important. When we do the reconciliation, we need to take these amounts into consideration. Then after, they tell us that depreciation for the current year amounts to 1,100. Remember, this depreciation is the depreciation for the furniture for the current year. So now they tell us that the depreciation for the current year on furniture was 1,000 rand, 100 rands. And after, they say under adjustment or additional information number 4 that no machinery has been sold during the year. Take note of that. They say no machinery was sold during the year, but it does not mean that there was no machinery that was acquired during the year. Let us just have an overview on that machinery note, and we see that from the statement of financial position, normally called the balance sheet. Let us go to our balance sheet. In our balance sheet, we have machinery at cost there in the middle. And the machinery at cost in the year 2006 was 50,625. And in the year 2007, it was 75,625. We see that there is an increase in the furnitures, in the machinery. Machinery last year was 50,625, but now it went up to 75,625. That means there was an item of machinery that was bought during the current year. Although there was no sale, but there was a purchase. So now the difference between the two, which will be 50,625 minus 75,625, this will be 25,000. That means 25,000 will be the acquisition of machinery. That means machinery that was purchased during the current year. And remember, this will be recorded in the cash flow from investing activities because we invest in assets. So now investing activities, that's where the business invests, and the business always invests in assets. So now this will go to cash flow from investing activities because we invest in assets, as I did mention that to you. So now I go to the requirements lastly, and I always recommend students to start with the requirements before they analyze the journal entries or any information provided. But in this day, I decided to start with the information provided. Requirement 1.1 says to us that the following ledger accounts for the year end 30 June 2007. That means they require us to do the ledger account for furniture, the ledger account for disposal of furniture. And remember, the first one is furniture at cost. That means we have to record the furniture at the cost price. And I want to bring your attention now once again to the third bullet point under number 3. I want to bring your attention to the third bullet point under number 3. Why am I bringing your attention there? Is because they say to us there, furniture with the carrying amount of how much? 3.2 was sold for 8,000. We don't know the cost price for this furniture, but we are required to do a ledger account for furniture at cost price. It means we have to try to work out the cost price of the furniture that was sold in the third bullet point. We have to know the cost price based on the given information that we have. So now take that into attention, and when you do the ledger account, I'll explain all of that. But be mindful of the fact that we need the cost price of the furniture that was sold for 8,000 rands. Sorry for that. Then now the third requirement is 1.2 or requirement 1.2, where we are required to do the reconciliation of the net profit with the cash generated from operations. Then after, in 1.3, we are required to do the cash flow statement for the year end 30 June in the year 2007. And I will start with a note. Please bear with me. I will start with a note. Then in the process of doing the second part, which is the cash flow 1.3, therefore now I will automatically cover the first requirement and the second part of the first requirement. So now I'll start with 1.2, then I'll do 1.3, and while I'm doing 1.3, I will cover 1.1. You'll see that when we do the cash flow, we always cover the ledger accounts. So now let us start with the reconciliation note of profit before tax with cash generated from operation. And this was question 5 of the November 2007 question paper. So now this is where we start in question 5. Question 5, and we are doing the reconciliation of profit before tax with cash generated from operation. Reconciliation of profit before tax with cash generated from operation. Profit before tax with cash generated from operations. That means we are removing items that are non-cash items with cash generated from operation. Cash generated from operations. So now we are doing the reconciliation note. A very simple note. This note starts with the profit before tax. Our profit before tax, it is normally given. Most of the times your profit before tax will be given. So now let us look for our profit before tax in this exercise. Your profit before tax will always be found in the income statement or maybe somewhere in the information provided to you. Our profit before tax is in the income statement. As I said to you that we are focusing in the current year, and the profit before tax in the year 2007 in the income statement is 49,900 in this exercise. 49,900 is the profit before tax, 49,900. Then we record that profit before tax as 49,900 rands. Then after we say non-cash items, non-cash flow items, Now, under non-cash flow items, we take into account items that are non-cash related. And the first item that is non-cash related will be depreciation. So now when we do depreciation, please open brackets immediately. Say depreciation, then open brackets. And one of the additional information told us that depreciation for furniture, that was the fourth bullet point under additional information number 3. Additional information number 3, we were told that depreciation was an amount of 1,100, the last bullet point. It said depreciation for the year amount to 1,100. Remember, adjustment or additional information number 3 was for furniture. So now that means the 1,100 of depreciation is the depreciation only for the furniture. So now we still have to take into account depreciations for other assets. So now let us say depreciation will be 1,100, and we say plus we go and we look for another asset which is a depreciable asset, and another asset which is a depreciable asset in this case will be a machinery. Therefore now under machinery we see that we have accumulated depreciation for machinery, and our accumulated depreciation for machinery in the year 2006 it was 10,125, and in the year 2007 it was 20,250. So now we calculate the difference between the two, and the difference between the two accumulated depreciations will give us depreciation for the current year for machinery. This will be 20,250 minus 10,125. And this will give us the depreciation on machinery as 10,125. Depreciation for machinery 10,125. For furniture, remember, it is 1,000 rand 100. 1,100 rands. Therefore, now we take that depreciation of 10,125. We add it to 1,100. And this will give us the total depreciation as 11,225 rands. And remember, depreciation is reducing the profit before tax. That means the reason why our profit before tax, it is the amount it is now, it is because depreciation was deducted in the gross profit. Therefore now when we do the reconciliation, we are reversing the depreciation. Therefore now to reverse an amount that was subtracted, we just add the amount back to make sure that we cancel the two entries, which was previously a negative. Now we record this as a positive to reverse the negative depreciation that was initially recorded in the income statement. Then after we write amortization of goodwill. I did mention to you what is amortization of goodwill. Amortization of goodwill, which is depreciation of intangible asset. Amortization of goodwill, even if you can write that as goodwill write-off as they did write it. Amortization of goodwill, and our amortization of goodwill was given in the income statement. Remember, amortization of goodwill is when the reputation or the goodwill of the business is losing value. Therefore now if that is the case, remember goodwill, it is an intangible asset. You cannot touch a goodwill. It is more like a reputation of the business. So now depreciation of intangible asset is called amortization. So now whenever an intangible asset is losing value, this is the case of the goodwill, losing the value. Therefore now that will be amortization of that asset, which in this case is the goodwill. And our amortization of goodwill is an amount of 1,000 rand. And remember that whenever the goodwill is losing value, that will be a loss, and a loss will be negative in the income statement. So now when we do a reversal of the loss, we record that as a reversal of the positive amount, because that loss was reducing, or that loss reduced the profit before tax when it was initially recorded. Then we have to record the write-down of furniture. The write-down of furniture. The write-down of furniture is the furniture that was written down. Write-down of furniture, where the furniture was written down. And we said that the write-down of furniture amounted to 100 rands, if my memory still serves me. I said that the furniture that was written down amounted to 100 rand. And we said that it is the difference between 800 and 700, where the carrying amount was 800 and the accumulated depreciation was 700. Therefore, now we said the loss of 100 rand will be recorded as a non-cash item. So now that means the loss of 100 rand is the one that we are reversing. Now remember, a loss is an expense. An expense is reducing the profit. So now we are reversing this loss because it is a non-cash item. So now we proceed with that and we go to the next part where we record the next entry. The next entry will be the profit. And the next entry being the profit will be the profit on the sale of the furniture. It will be a profit on the sale of the furniture. Profit on sale of furniture. Remember, there was a furniture that was sold, and that furniture was sold and a profit was made on the sale of the furniture, if you still remember. And that was the third bullet point under additional information number 3. The third bullet point, where a furniture with the carrying amount of 3.2 was sold at a price of 8,000, which is higher from 3.2 by 4.8. And we said that this is a profit on the sale of the furniture. A profit on the sale of the furniture. And also a profit is a non-cash item. So now that 4,800 must be removed from the profit. So now it will have to be negative because a profit is increasing the profit. Remember, a profit is income. Therefore now that will mean this profit would have increased the net profit. Therefore now when we remove that, we have to record it as a negative. So now these are the items that would have been recorded as non-cash items. Let us draw the line or the box, then we calculate the total of these non-cash items only. Therefore, now we start with the depreciation of 11,225 plus 1,000 rand plus 100 minus 4,800, and this will give us a total of 7,525 rands. And take note, this amount is positive. Signs when it comes to cash flow, they are very crucial. So now we go to the second part of the cash flow where we record items that are shown in the main statement. Items that are shown in the main statement. Items shown in main statement. So now the item that are shown in the main statement are the item that you can visibly see in your income statement. And that will normally be your dividends income, your interest income, and your finance cost. Items that are separately disclosed in the income statement. And those items are not for the operation of the business. Therefore, now the first one will be finance cost of 5,000 rands. The second one will be investment income of 8,500. So now those will be the two. If there was dividends income, that was going to be recorded again here as one of the items that are shown in the main income statement. So the first one will be finance cost. And remember, finance cost is an expense. And expense, they reduce the profit. So now for us to reverse that, we have to record the finance cost as a positive because we are reversing the finance cost which was initially recorded as a negative. Then after we have interest income, and the interest income will have to be negative. And the interest income, I think we said that will be an amount of 8,500 negative because we are reversing the income which was recorded as a positive, increasing the profit. So now that will mean the total will be 3,500 negative because it's 5,000 minus 8,500 because 8.5 is negative. So now the total of the items that are shown in the main statement will be negative 3,500. And after we do the last part of the cash flow, the last part of the reconciliation note, in fact, which is working capital changes, which is working capital changes. And our working capital changes is made of inventory, account receivables, and is also made of account payables. So now let us look at the inventory. If is the inventory increasing or decreasing? Our inventory will be found in the statement of financial position. And that inventory, we can see that inventory in the year 2006, it was 281,690, and in the year 2007, it is 245,625. And this is a decrease in inventory. So the minute our inventory is decreasing, I said to you in the previous video that when it comes to inventory, in the reconciliation note under working capital changes, we always assume cash basis. That means if inventory is decreasing, that means we sold inventory for cash and money was received. And if inventory is increasing, it means that we bought inventory for cash, therefore now money went out. So now in this case, let us calculate the difference and we'll see how much is the decrease in inventory. 281,690 minus 245,625 will give us an amount of 36,065. That will be the amount by which our inventory decreased by. And when inventory decreases, as I said to you, that we always assume cash basis. Therefore now we will say decrease in inventory means we sold inventory and money was received. And we say decrease inventory, and that will be 36,065. 36,065. And if money was received, therefore now this will be recognized as positive cash received for the operation of the business, which is inventory decreasing because of sales. And then after we go to account receivables. We go to account receivables, and remember the working capital changes are three elements: inventory, account receivables, and account payables. So now our account receivables, normally called debtors, they're in the middle of your income of your balance sheet. There we have our debtors. In the year 2006, debtors were 180,000. In the year 2007, they decreased to 150,000, and they decreased by how much? Obviously 30,000 rands. 180,000 minus 150,000 will give you 30,000 rands. 180 minus 150 will be 30,000 rands. That means our account receivables decreased by 30,000 rands. And the reason why account receivables decrease is probably because they paid our money back. So now whenever they pay our money back, therefore now that will be cash coming into the business. Therefore now that 30,000 will be recorded as positive, indicating inflow of cash. Then after now it will be decrease in account receivables, or decrease in debtors. If you want, you can just say decrease debtors by 30,000 rands. That will be positive. Then we go to the third element, or the third component of the working capital changes, which is our creditors. Our creditors, sometimes called account payables. We see that our account payables were 69,000 rands in the previous year. They were 69,000 rands, 990, and in the current year they decreased to 18,800. That means obviously we would have paid our creditors. The reason why they decrease because we paid them. And if we pay them, money will go out of the business. That will be indicated as outflow of cash in brackets. So now it will be 60,990 minus 18,800. So now that will mean a total of 42,190 would have been paid to our creditors between the end of the previous year and the end of the current year. So now that will be a decrease in account payables. So now all these elements, they decrease, but although they decrease, the effect is recorded differently. Decrease in account payables, and this decrease, as we said, that it will be 42,190 rand, indicated as negative because there is outflow of cash because of the payment of our account payables. Therefore now we can calculate the total of the two, which is 36,065 plus 30,000 minus 42,190, and this will give us 210. That will give us 23,875. This will give us 23,875. And remember, this amount is also positive. Take note of that too. Therefore, now we have to calculate our cash generated from operations. Then we calculate our cash generated from operation. Cash generated from operations. Then this will be the total. And our cash generated from operations will be the net profit before tax of 49,900 plus 7,525 minus 3,500 plus 23,875, and this will give us 77,800. Then now the 77,800 will be the cash generated from operations, which is 77,800 rands. Then that will be 77,800 rands as cash generated from operations. Then now we go to the second requirement, which is the last requirements, cash flow. That will be, I think it was 1.3 or 5.3 of the question, 1.3 of the requirement, yes, 1.3. Then we do the statement of cash flow. Statement of cash flow for the year end, which is the year 2007. Statement of cash flow. For the year end, and the year end, let us check the year end. The year end is the year 2007, which is 30 June 2007. For the year end, 30 June 2007. That will be 30 June 2007. Then now we start with our cash flow, and we know that our cash flow starts with the cash flow from operating activities. Cash flows from operating activities. Cash flow from operating activities. And our cash flow from operating activities start with cash received from customers. Cash received from customers. And our cash received from customers, now we first have to start doing the workings. This is where the calculations becomes very important. Now our cash received from customers, we have to first calculate or check the amount of account receivables, then also the sales. Then after, we also take into account the closing balance of our debtors. We have our debtors in the balance sheet. Debtors is an amount of 180,000 opening balance. So now when we do the workings for the amount of the cash received from customers, we say opening balance. Opening balance plus sales minus closing balance. Remember, you can also do this in the ledger account. Sales will be recorded on the debit side of debtors. So now we say opening balance of debtors. And our opening balance of debtors, it is 180,000 rands. And our sales are found in the income statement. Our sales is the gross revenue. If you remember the gross revenue under sales, gross revenue was 200,000 rands. There was gross revenue of 200,000 rands. So now our sales will be the gross revenue of 200,000 rands. We plus that, then after we minus the closing amount of debtors, which is 150,000 rands. Therefore now this will give us cash received from customers. This will give us cash received from customers. This is how you calculate the cash received from customers, meaning it will be 180,000 rands plus 200,000 rands minus 150,000 rands, and this will give us 230,000 rands. And the 230,000 rands will be cash that was received from customers. Cash received from customers. So now our cash received from customers will be 230,000 rands, as I did show you the calculations. 230,000 rands will be the cash received from customers. The second part is cash paid to suppliers and employees. Cash paid to suppliers and employees plus employees. Then we normally leave this blank, then we'll strike the difference to determine this amount. Then we can just draw a line below that. Then after we say cash generated from operations. Cash generated from operations. And our cash generated from operations, it was calculated, remember, in the reconciliation note. Our reconciliation note, we had cash generated from operations, and that cash generated from operations was 77,800. So now that is where this amount is coming from. Therefore now 77,800 is the cash generated from operations. Therefore now this will give us the difference, and the difference will be the cash paid to suppliers and employees. And the cash paid to suppliers and employees will be 230,000, which is cash received from customers minus cash generated from operation of 77,800. Therefore now that will give us 152,200 rands. 152,200 rands. That will be how you generate or how you calculate the cash paid to suppliers and employees. Then now we proceed to the 4 items that get to be recorded in the cash flow from investing activities. The next one will be interest received. Let us start with the interest paid. We start with the interest paid. Then after interest received. Then after dividends paid. Dividends paid. Then the next one will be dividends received. The last one will be normal tax paid. The last one will be normal tax paid. So we have all these 5. Make sure that you memorize all of them. They are in your head. When you enter the exam and you do cash flow, you write all 4 of them, all 5 of them. Now, the interest that was paid will be the finance cost, which is interest expense. So now our finance cost will be found in the income statement. Then in the income statement, we had finance cost of 5,000 rands. That 5,000 rands, we assume that it was all paid. And remember, it's not all the time that finance cost will be the one that was paid. There might be a portion that was accrued. Now, if the adjustment stipulates clearly that a portion of the finance cost was still accrued, therefore now in the cash flow, we will only record the amount that was paid and not the one that was accrued, because an accrued expense is expense not yet paid. Please take note of that, guys. It's very important, more especially for cash flow at 3011. So now in this case, we assume that the full finance cost was all paid unless it was stipulated that there was a portion which was accrued. So now the full 5,000 will be a negative 5,000 rands. Money went out. This is cash flow. We record the cash. Whenever money goes out, it will be negative. Whenever cash goes in, then it will be positive. Then there was also interest that was received. And interest that was received is also found in the same income statement, the investment income, 8,500. And also, once again, remember, if there was accrued interest in the current year, that accrued interest will have to be deducted in this main interest income so that we get the portion that was received. And the portion that was received is the one that was going to be recorded here as interest received. But in this case, we assume that all the interest that appear in the income statement was all received. Then after now we check if were there any dividends that were paid and any dividends that were received after that. Let us check if we do have any dividends or not. Yes, we do have our dividends, and our dividends, they amount to 20,000 rands and ordinary. Then after there's also preference, and the preference is 1,500 rands, and all of them, they were declared and paid. Therefore now the total of that will be 21,500. But we need to go and check first in the statement of financial position if is there any shareholders for dividends. Remember, shareholders for dividends will be the dividends that were not yet paid by the end of the specific accounting period. So now we look down in the balance sheet and we see that there is no shareholders for dividends. And remember, if there was shareholders for dividends, we'll first have to make sure that we take the opening balance, we add what was declared in the current year, and to subtract the closing balance to determine the amount that was paid by the end of the given period, which will be the current year. So now in this case, we'll have 21,500 as dividends that were declared and paid. So dividends paid will be 21,500 rands. 21,500 negative because that is money going out, cash outflow, paid in the form of dividends. And we had no dividends that were received. I did not see anything that spoke about the dividend that were received throughout this activity. There were no dividends that were received. So now that means I can just remove the item for dividends received just to make sure that I save space. Therefore now the next part that we'll be doing will be the normal tax. Normal tax paid or taxation paid. And our taxation paid, we need to check in the trial balance too. If is there anything that is written SARS or current tax refundable or current tax payable. And yes, there is something in this exercise that says current tax refundable income tax. And now we see that this is current tax refundable. That means SARS is supposed to refund us back. And it is without brackets. And the minute there's no brackets, we know that this is an asset. So now it has a debit balance. Therefore, now it means we have to calculate our taxation, where we do the same thing and we say opening balance. Then after we say taxation expense. Then after we have closing balance. And please take note that when it comes to the tax, our opening balance is an asset. So now the opening balance is the one that will be negative. Opening balance is an asset of 6,000 is the one that will be negative. I'll explain this in a ledger account perspective. Then our taxation is in the income statement. Our taxation in the income statement is income tax of 14,400 rands. Income tax of 14,400 rands. Then after closing balance is 46,000. Closing balance will be positive 46,000. Opening will be negative in this case. I will explain to you in the ledger account immediately when I'm done with this. Then now it means we'll have to say 14,400 plus 46,000 minus opening balance of 6,000. Minus opening balance of 6,000. This will give us 54,400 rands. This will be tax paid. This will be tax paid. I'll show you why now all of a sudden the opening balance is becoming negative. Let me do the ledger account for current tax. Let me do a ledger account for current tax. Normal tax. Our current tax, normal tax, remember in the statement of financial position, it is an asset. So now if it is an asset, it means the opening balance, which is 6,000, will be on the debit side. So now the opening balance will be on the debit side. It will be 6,000 rands. And the closing balance, which is the balance carried down. Remember, balance carried down for an asset is on the credit side. So now 46,000 will be on the credit side, which is the balance carried down, balance at the end of the year. 46,000 rands. Then now we have to record the tax expense for the year. And taxation expense for the year will be on the credit side of the ledger account, and that will be 14,400 rands. Remember that 14,400 is the one that is from the income statement tax expense for the current year. So now we can see that the bigger side will be obviously the credit side. So now in this case it will be the credit side, meaning we'll have to say 14,400 of the tax expense plus 46,000, which is the closing balance. This will give us 60,400. 60,400. Then now we see that we say minus the opening balance. That is why the opening balance was deducted. I think now you are very clear. Therefore now this will be 54,400 and the contra entry will be bank on the debit side. So now that is why the opening balance was deducted. Is that I understood why it must be deducted. So now we go and we record that 54,400 as 54,400 negative because taxation was paid out to SARS. Then now from here we can draw the line throughout the line for the calculation of the total of cash flow from operating activities. So that means it will be 77,800, which is cash generated from operation, minus 5,000 plus 8,500 minus 21,500 minus 54,400. Then this will give us an amount of 5,400 rands. And the 5,400 rands will be a positive amount. Take note of the signs. Signs are very crucial when it comes to the topic of cash flow. It will be positive 5,400 rands. Then now we go to the next part of cash flow, which is cash flow from investing activities. Cash flow from investing activities. And this part is also very important for you to understand the calculations. Cash flow from investing activities. Very important to understand the calculations here because they will normally give you some different scenarios to test your level of intelligence and how critical thinker you are. So now we know that we are focusing on the investments here. And the investment, we know that the company invests in assets. So now that means we are focusing on the asset section of the statement of financial position. And now the asset section, we know that it was under number 3 or additional information number 3. And we have to go to under additional information number 3 and we analyze all the information with regard to the furniture there. So now the first one said that furniture to the amount of 5,500 was purchased. So now if we buy the furniture, money will go out. So now let us go and we record that as acquisition of furniture. That means we bought furniture. Acquisition of furniture. So now if we buy furniture, that means money will go out because of the purchase of the furniture. So now that will be negative 5,500 rands. Negative 5,500 rands. That is the furniture that was acquired in the first additional information number 3. It was purchased and we always assume cash. We are dealing with cash flow here. Then now the second bullet point said that a furniture with a cost price of 800 rands and an accumulated depreciation of 700 was written off. And we said that the cost of the furniture was 800 and we said the carrying amount of this furniture will be 100 rands, and that carrying amount became a loss because it was written off. So now there was no money that came in because of the furniture that was written off. So now if there's no money that came in, either went out, therefore now it will not affect our cash flow. So now that means this is not a cash flow item, but it will do affect our ledger account for furniture, which is requirement number 1.1.1. So far let us keep it, but keep it in our mind. The next one is the furniture in the third bullet point, where they say to us, furniture at the carrying value of 3.2, or furniture with the carrying value of 3.2 was sold for how much? For 8,000. And I said this is money that we received. We sold it for 8,000 rands. So now 8,000 was received. And any money that you receive because of the sale of the asset must go to cash flow under investing activities. That will be proceeds from the sale of furniture. Proceeds from the sale of furniture. That means the money that we received on the sale of this furniture, of which we received 8,000 rands. So now that will be recorded as proceeds on the sale of the furniture. Money received on the sale of the furniture. So now from here, we know that the last bullet point under number 3 is the depreciation of furniture. Therefore, now we need to check if was not there maybe any other furniture that was bought during the year or purchased during the year. So now by doing that, we have to go and we do ledger account so that we are also able to answer requirement 1.1.1. And don't forget that I said the third bullet point, if you still remember, the third bullet point, we still need to know how much is the cost of the furniture that was sold. Third bullet point, we know that furniture with the carrying amount of 3.2 was sold for 8,000. And we know that to get to the cost price, the cost of the asset is equal to carrying amount plus accumulated depreciation. That is how else you can calculate the cost price. The cost price is the carrying amount plus accumulated depreciation. And in this case, we do have the carrying amount. Our carrying amount is 3,200. But we don't know the accumulated depreciation for the furniture that was sold. We know the accumulated depreciation for all the furnitures in the balance sheet. Go to the balance sheet now. In the statement of financial position, we do have accumulated depreciation for furnitures. And that accumulated depreciation for furnitures is for all the furnitures, not only for the furniture that was sold for 8,000. So now we need to open a ledger account for accumulated depreciation so that we are able to get the accumulated depreciation for the furniture in the third bullet point, which was sold for 8,000, of which the carrying amount was 3.2. So now that is why we have to go and open the ledger account for accumulated depreciation. So now let us open the ledger account for accumulated depreciation on furniture. Accumulated depreciation. And we are doing this for the furniture. And we know that the opening balance of the accumulated depreciation is on the credit side. This will be balance. And let's go to the statement of financial position and review how much the balance of all the furnitures, accumulated depreciation. Opening balance will be from the year 26, 32,000 rands. The year 26, 32,000 rands. 32,000 rands. Closing balance will go to the credit side. Please skip 3 lines. Balance carried down is the balance at the end of the current year, or balance end of the current year, which is 13,600 rands. Accumulated depreciation for furniture. 13,600 rands. 13,600 rands. And from here now we need to record all the entries that must be recorded under the accumulated depreciation, the one that are given to us. We must record all of them. We know that the depreciation get to be recorded on the credit side of the accumulated depreciation. So now that means in this ledger account, we already know that depreciation for furnitures was how much? 1,100. Depreciation was 1,100. It was 1,100, and we know that depreciation get to be recorded on the credit side. That was under bullet point number 3, the last bullet point under additional information number 3. that was the depreciation for the furniture 1,100. We record that. And take note of the second bullet point under number 3. The second bullet point said to us that furniture with the cost price of 800 and an accumulated depreciation of how much? 700. And we know that if the asset is written off, they say it was written off. Therefore, now if the asset is written off, its accumulated depreciation must also be removed in the books of the business. Therefore, now it means that 700 of the furniture that was written off, accumulated depreciation, must be written off on the debit side of the accumulated depreciation. So now let us record that as 700. And to say 700 write-off furniture. Writing off furniture. That means furniture is written off. Furniture write-off of 700 rands, which is the total accumulated depreciation for this furniture that was written off. Now we have recorded all that is concerning the accumulated depreciation ledger account. Now, if we strike the total will be obviously 32,000 credit side plus 1,100, which the bigger side will be 33,100. Bigger side 33,100, and we say minus 700 in the debit side, minus closing balance of 13,600, and this will give us 18,800. What is this 18,800 for? 18,800. So now the 18,800 will be the accumulated depreciation for the furniture that was sold for 8,000. So now this will be asset disposal because this furniture was sold. Asset disposal. So now that means the minute you get the difference in this ledger account falling on the debit side, it means it is the accumulated depreciation for an asset that was sold. So now in this case, we know that there was a furniture under bullet point number 3 in adjustment number 3, where they told us that the furniture with the carrying amount of 3.2. Therefore, now we can calculate the cost price of the furniture. Meaning now, the cost price of this furniture would have been carrying amount plus accumulated depreciation. And we know that the carrying amount was 3,200. And we know that the accumulated depreciation is 18,800. Therefore, now the total cost of this furniture would have been 22,000 rands, if I am not mistaken. It will be 18.8 plus 3,200. This will be 22,000 rands. So now this is the cost price of this furniture that was sold at the selling price of 8,000, where a profit of 4,800 was made. Please take note of this. It is very, very important. So now we do have the cost here. The cost is equal to 22,000 rands. So now we have covered that aspect. So now let us go to the ledger account and we see that everything is complete. So now the ledger account for accumulated depreciation, it is complete, done and dusted. Now let us do now the ledger account which was required now, which is furniture at cost. Because we know the cost price for the furniture that was bought, first bullet point, and we know the cost price for the furniture that was written off, second bullet point, and we also know the cost price for the furniture that was sold in bullet point number 3. So now we have all the cost price, therefore now we can do the ledger account for furniture at cost. That is why I wanted to do this as the last one. Then we say ledger account, furniture at cost. This is 1.1.1. And we are doing the ledger account for furniture at cost. And now we throw the ledger account and we start with the opening balance. Opening balance will be on the debit side. And the opening balance will be taken from the statement of financial position, or from the extract of the statement. And the extract of the statement, we do have an opening balance there. Opening balance for the furniture at the cost price. There we have furniture, opening balance 36,800, which is the closing balance of the year 2006, become opening balance of the year 2007. And remember, this is an asset. There are no brackets indicating that furniture is an asset. 36,800. Opening balance 36,800. And the closing balance will be on the credit side. And the closing balance will be on the credit side, which is balance brought down. And I think it is 19,500. That is 19,500 closing balance at the end of the current year of furniture. Then now we have to record the furniture cost that was written off. On the credit side, we say write down of furniture. Write down of furniture. That means we are recording the cost price of the furniture that was written down. And we know that the cost price of the furniture that was written down, they gave to us that it was 800 rand cost. So now the cost of the furniture that was written down was 800 rands. Then we also know that there was a furniture that was sold. Remember, there was a furniture that was sold where we calculated the cost price for that. Therefore, now it will be asset disposal on the credit side. Asset disposal on the credit side, and that will be 22,000 rands. We have calculated that to be 22,000 rands. Remember, we said 18,000 plus the 3.2. 18,000 plus the carrying amount of 3.2. And that gave us the cost of 22,000 rands. And the cost of this furniture that was sold at a profit of 4,800 rands. So now we have recorded everything with regard to the furniture. We can balance our furniture ledger account from here. Or let us record, I think there was a furniture that was bought. Don't forget. Let us check if did we record everything. There was a furniture, which is the first furniture. First additional information under number 3. Where they said to us that furniture to the amount of 5.5 was purchased. We cannot ignore that. We cannot forget that. So let us record that in the furniture cost on the debit side. And it will be bank on the debit side 5,500 rands. So now that means we have covered everything that needed to be recorded here. So now from here we can just balance, and our debit side I think supposed to be equal as our credit side. So now we say 22,000 on the credit side plus 800 plus 19,500, and this gives us a total of 42,300. And our debit side, it is 36,800 plus 5,500, and this gives us the same amount of 42,300. That means there was no further furniture that was bought or sold during the current year. Now the next ledger account that we need to do is the ledger account for the next requirement, which is asset disposal. Asset disposal. Remember, asset disposal was requirement 1.2, or disposal of furniture. 1.1.2, asset disposal. So now we are doing the disposal of furniture. And remember, only one furniture was disposed. Only one furniture was disposed. And that furniture that was disposed was costing how much? 22,000 rands. Remember, I think it was the third bullet point under information number 3, where they said furniture with the carrying amount was sold. Remember, the second one, it was written off. The first one, it was a purchase. There was no other purchase, and there was no other sale after that. So now on the debit side of the asset disposal, we need to record furniture, which is the cost price of the furniture that was sold. And the cost price of the furniture that was sold, we calculated that to be 22,000 rands, remember. Then after we have to record on the credit side the accumulated depreciation for the furniture that was sold. Accumulated depreciation for the furniture that was sold, it was 18,800. It came from our calculation in the accumulated depreciation ledger account. So hence it was important for us to do that too. And we know that it was sold for cash. Therefore now on the credit side we record bank, money that was received. And bank will be 8,000 rands, money that was received on the sale of this furniture. Then the difference will be a profit. We already know that there was a profit. And the profit was 4,800. And the profit will be on the debit side of the ledger account of asset disposal. And it will be profit on sale of furniture. Profit on sale of furniture. on the debit side. So now after we have recorded all this, our ledger account is supposed to be equal, both sides is supposed to be the same. Debit side is supposed to be the same as the credit side. Therefore now this will be 18,800 plus 800. It will give us 19,600. Let us check something does not balance. We must have done something wrong. We have accumulated on the credit side, which is 18,800. Then we have 8,000. Okay, record. I typed it incorrectly. 18,800 plus 8,000. Then that will be 26,800. Then the total is 26,800, which is 26,800. Then debit side is 22,000 rands plus 4,800. That is the same 26,800. Exactly what I said. It must be the same both sides. So now we have answered requirement 1.1.2 and 1.1.1 while we are busy doing our cash flow from investing activities. So now we have done this ledger account and we can go to our cash flow. Now we proceed with our cash flow. We have recorded the one that was sold, we have recorded the one that was acquired, and we recorded the proceeds on the sale and the acquisition. So now we have to look for another asset now that was bought maybe during the period. And we do have another asset that we have to take into account. And that other asset is machinery. Another asset that we have was machinery. Then I will look for machinery, and our machinery is cost price in the previous year was 50,625. In the current year, 75,625. So now we see that there is an increase in the machinery. That means we would have bought, or we might have bought a machine in the current year. 50,625 minus 75,625. This will give us 25,000 rands. That means we bought machinery to the value of 25,000 rands in the current year. Therefore now we will have acquisitions of machinery. Acquisition of machinery. That means machinery that was acquired during the year, because our machines increase. And machines can increase if we buy a new machine. Negative indicating money going out of the business. Then now we look for another asset that might still be there in the extract of the statement of financial position. Any other asset? If we look down, there is investment. Investment is an asset. The second bullet point, or the second line item in the statement of financial position. Investment there, it is 50,000 rands in the current year and 40,000 rands in the previous year. We see that our investment increased by 10,000 rands. That means the company took money out of the business and they invested that in the current year. From the end of last year up to the current year, they invested 10,000 rands. So now that 10,000 rands will be recorded as money going out of the business and it was invested. Therefore now, under cash flow from investing activities, this will be acquisition of investment. Acquisitions of investment. That means the business acquired an investment that amounted to 10,000 rands. So now that will be recorded as cash going out of the business. And with that, we have covered all the assets. We can just have an overview. All the investing assets were covered. Remember, debtors and inventory, they affected the reconciliation, so they are already taken into account. So please don't make a mistake of saying debtors are assets and also inventory is an asset. Yes, they are assets, but they were already taken into account when we did the reconciliation note under working capital changes. So now we have to write the total of these four amounts. Then this will be 8,000. I want to start with the positive one. Minus 5,500. Minus 25,000. Minus 10,000. And this gives us 32,500 negative. 32,500 negative. Take note of the signs as I do mention this to you frequently. Then we are done with the cash flow from investing activities. Then after we do cash flow from financing activities, the very easiest part of them all. Cash flow from financing activities. Cash flows from financing activities. This is where the business gets money to finance its operations or to finance its investments. Now we have to look if were there any shares that were issued, was there any loan that was raised, were there any shares that were redeemed, was there any loan that was repaid, were there any dividends that were issued, or were there any debentures that were redeemed. It's all about around those concepts. The first information, which is additional, said to us that on the end of January-February 2007, a right issue of 1 share for every 5 shares held were issued at 3 Rand 40 cents per share. So now that means we have to calculate the value of these shares that were issued at the right issue. And remember, right issue are the shares that are issued at the lower price to existing shareholders. They say 1 share for every 5 shares. That means now it will have to be 50,000 divided by 5. It will have to be 50,000 divided by 5, where we are calculating the right issue. It will be 50,000 shares times by 1 divided by 5. So now if we do that, it will be 50,000 times by 1 divided by 5. And this will give us 10,000 shares. That means 10,000 shares were the right issue shares. Then we multiply this by the price, the share issue price. And the share issue price is 3 Rand 40 cents. Share issue price is 3 Rand 40 cents. Therefore, now we say times this by 3 Rand 40 cents. And it will give us 34,000 rands. Therefore, now 34,000 rands will be the right issue, which will be recorded as the proceeds from the issue of ordinary shares. Proceeds from the issue of ordinary shares. Remember, right issue is only done on ordinary shares, not on preference. Proceeds from the issue of ordinary shares, or from the issue of shares. And those proceeds amounted to 34,000 rands. And it's money that came into the business because of the issue of shares. Although they receive a smaller money than it would have been if they were issued at the market price, but the company still received this amount of shares from the shareholders that were already existing. Then now we have already captured that. And the next one now will be the information number 2, additional information number 2, where they said to us on the 1st of January 2007, meaning the beginning of the current year, 10,000 redeemable preference shares were redeemed at 13,000 rands. And I did clarify to you that there is a premium that is already included. And if premium was not included, you will have to calculate the premium. Then after you pay the total, if the company paid the full redemption, including the capital and the premium. So now you'll have to add all these two when it comes to the redemption. In this case, we say that 10,000 preference shares were redeemed. And these preference shares, we say that they were issued at 1 Rand. So if these shares were issued at 1 Rand, therefore now they were supposed to be redeemed at 1 Rand times by 10,000, which will give us 10,000 preference capital that was redeemed. However, now there is already 13,000, indicating that 3,000 was the premium on the redemption of preferences. However, the full amount was paid. Therefore, now we write that as redemption of preferences under financing activities. Redemption of preferences. Redemption of preferences. Let me just write this in brackets and show the workings in case maybe some examiner they will require that. Let us just open brackets and you say 10,000, which is the capital, plus 3,000, which is the premium. Therefore, now this will give us 13,000 rands. So that's where the 13,000 rands is coming from. Is the total of the capital of 10,000 that was redeemed plus the premium of 3,000. Hence, we only see 13,000. However, it is the sum of the two amounts. So I just want to give you a broader clarity in terms of this entry. Then after now we have covered that, and there was no other adjustment. All others were taken into account. Let us look now for the debentures and also look for the loan. Is there any debenture and is there any loan that was paid maybe during the year? So now let us look for that. We do have a debenture, which is the last entry there. Debenture of 80,000 last year and debentures of 120,000 current year. We see that our debentures, they increase. Remember, debentures, they work as a form of funding or the form of financing. That means the company needed more funding in the current year and they issued debentures. Therefore, now they receive more money. And that more money will be the difference between 80,000 and 120,000, because last year we already had debentures, but our debentures, they just increased by 40,000, which is 80,000 minus 120,000. That means 40,000 is money that was received in the current year because of the issue of debentures. So now that will be debentures acquired. This will be debentures acquired. So now we say debentures acquired. That means the business acquired, or let me say acquisition of debentures, so that I'm just consistent with my writing. Acquisition of debentures. Acquisition of debentures. Because it's normally written like that. Acquisition of debentures. And acquisition of debentures amounted to 40,000 rands, where the company raised some funding. And don't forget that 13,000 is negative, the previous one. Redemption of preference shares must be negative because money was paid to shareholders. I just forgot to write that as negative. So now debentures, we received money in this case, and that was 40,000. And let us check if is there any short-term loan or any long-term loan in the statement of financial position. And there is no short-term loan, and also there is no long-term loan when it comes to this extract of the statement of financial position. And from here now we can calculate the total of the cash flow from financing activities. And when we do that, it will be 34,000 plus 40,000 minus 13,000. That will give us 61,000 rands positive. Therefore, now we can say 61,000 rands positive minus 32,500 cash flow from investing activities plus 5,400, which is cash flow from operating activities. And this will give us 33,900 rands. This will give us 33,900 rands. Let us just have a rough check if our figures are going to balance or not at this stage of our cash flow. So now we have our banking balances there. This first bank balance is 22,900 plus 11,000. That gives us 33,900. Therefore, now surely our cash flow will balance. I was just doing the test before. Maybe I get surprised when things they don't balance. So now this will be net increase in cash and cash equivalent. Why am I saying this is an increase? Is because I already know that the opening bank balance was an overdraft. Bank overdraft or opening bank balance was an overdraft, and it was 11,000. So now it went up to 22,900 by 33,900 rands. So now we'll have a cash and cash equivalent beginning of the year. Although I don't have space, it will be cash and cash equivalent, cash and cash equivalent, beginning of the year, and our cash and cash equivalent beginning of the year was negative 11,000. It was negative 11,000. Then after we had the last one, which was cash and cash equivalent at the end of the year. Cash and cash equivalent at the end of the year. And cash and cash equivalent end of the year was 22,900 rands. And now I can draw a line here. Remember, opening balance is negative. And I want to bring your attention to this closing balances here, because there's something that is very crucial for you not to miss. We have cash and cash equivalent, cash and cash equivalent beginning of the year, cash and cash, just want to clarify this, cash and cash equivalent beginning of the year, which is negative 11,000, and the closing balance is positive 22,900. Cash and cash equivalent at the end of the year. This is beginning. So now remember, for us to calculate either an increase or a decrease, we say closing minus opening. In other words, we say closing minus opening. That's the basic principle of the net increase or decrease. Closing minus opening. And our closing is 22,900. Minus, you put the minus sign. And our opening is negative. That means minus and another minus. Therefore now in brackets negative 11,000. So therefore now negative times by negative will give us positive, because our opening is negative. So now we say 22 minus a negative amount. Therefore now it will be 22,900 plus 11,000. That is why we end up with 33,000 positive 900, which is net increase in cash and cash equivalent. 33,900 rands. So now our cash flow does balance. Sorry for me to squeeze that part, but I hope you have enjoyed this session, and God be with you. Thank you, gentlemen and ladies.